Hey, welcome back, options traders. Well, it's Friday again, and I've got a good question for the group. What are the three P's of options? And I know that these are three terms that often confuse new traders, so I thought it might help some of the newer traders in our group. So, what are the three P's? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always greatly appreciated. So, the three P's, what are they? Well, the first one is premium, the second is payoff, and the third is profit. So, how are these used? Well, let's start with premium. The premium is simply the total options price. It's the intrinsic value plus the extrinsic value. So, for example, let's say that the stock is 105 and we see that the $100 call is trading for 7. So, again, this is the price that you see in your broker's platform. That would mean $7 per share or $700 per contract. But because it's a $100 call with the stock at 105, there's $5 of intrinsic value. However, the option is trading for 7. So there's an extra $2 that's not being accounted for. That's the extrinsic. And as always, if we add the intrinsic plus the extrinsic, we get the option's total price. So whenever we talk about premium, it is this price, in this example, the $7 total that we're talking about. Now, also remember that options were born out of insurance theory, and that's the same term that's used in the world of insurance. You pay the option premium. So that's another way to remember what the premium is in the world of options. Let's go to the second one. What is the payoff? Well, the payoff simply looks at what the option is worth at expiration. So this is a payoff diagram. We've looked at some of these in some of the videos. Most of the time it's a profit and loss diagram, which we'll look at in a moment. But a payoff diagram lines up right here at 0. So you can think of a payoff diagram as the option, whether it's a call or a put, or some other strategy for that matter, where you paid nothing for it. And what that does, it simply shows what the option pays at expiration. So for example, here's our $100 call. There's our bend at 100. And let's say that the stock is down here at 85 at expiration. Well, the option pays off 0. This doesn't mean that you lost 0. It just means that the option is not going to return anything. It expired worthless. That's what it means to be the payoff. What if the stock is up here at 110 at expiration? Well, we trace a line from 110 up to our payoff diagram. It's worth $10 of intrinsic value. We have the right to pay 100 with our call with the stock at 110. Well, that's a $10 benefit. So the option pays off $10 at expiration. What if the stock is way up here at, let's say, 120? Well, we find 120, we trace a line up to the black line, the payoff diagram, and we see it lines up at 20. And again, that's because we have the right to pay 100 with the stock at 120. So the option is worth 20. Now again, don't confuse that to mean that you made $20. You still could have lost money here. It depends on what you paid. But the payoff diagram simply shows what the option will be worth at expiration, regardless of what you paid or what you received from selling it. Okay, what about the last one here, profit? Well, profit combines these two. Well, whenever we're talking about profit, we are simply saying what is the option's payoff minus the premium. That's actually going to show what lands in your pocket. So in our example, we have the $100 call that was trading for 7. So let's say that the stock is down here at 95 at expiration. We know that the option pays off 0, but you're going to end up with a $7 loss because that's what you paid for it. So you paid 7, you received 0. That gives you a net loss of 7. What if the stock is up here at 110? Well, we know that the payoff is 10, but because you paid 7, you now have a $3 profit. What if the stock is up here at 120? The option pays off 20, but because you paid 7, you would have a profit of 13. So now it will make more sense when we combine those two concepts. And that's what leads to a profit and loss diagram. Do you see how this one doesn't line up at 0? In fact, it lines up at -7 because that's the price that we paid. So now if we say that the stock is 95 at expiration, we trace a line down, we see that it lines up at -7. See, that's taking into account the price paid. But notice that's not the option's payoff. The option paid off 0, and it left you with a $7 loss. If the stock is up here at 110 at expiration, we trace a line up to our profit and loss line, and right where it touches, we look left, and there it is. Lines up at +3. The option paid off 10, but after subtracting out the $7 cost, the profit and loss diagram takes us right to the bottom line result. It shows that you have a profit of 3. And then finally, if the stock is up here at 120 at expiration, we know the option pays off 20, but because you paid 7, see, it lines up right there at 13. So again, this is where some of the traders get confused. They'll look at a profit and loss diagram, which is the most common diagram, especially on your broker's platforms, and they'll say, oh, the option paid off 13. No, it didn't. The option paid off 20. But after subtracting out the $7 premium, it left you with a $3 profit. So remember the 3 P's. They are premium, payoff, and profit. And so depending on the situation, you may need to refer to premium, payoff, or profit. And that's why you must understand what each means. So those are the 3 P terms that sometimes throw new traders. So I hope that helps to make sense of these 3 important concepts. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.